We have this package called the Belt and Suspenders for private lenders. So if you're a private lender or hard money lender and you're lending money to a real estate investor who's buying a property, and it's typically a fix and a flip. They're buying it, gonna hold it for a year max, fix it up, renovate it, and sell it. So your loan is typically going to be a higher interest rate, higher risk. And also your valuation when you're underwriting that loan is going to be based on after repair value. So the house may only be worth $30,000 or $40,000. So let's say they're buying this house at $30,000 today, but you're going to lend them $150,000 because it needs that much work. What we recommend in that case is you use our Belt and Suspenders package to do your loan. In this case, at closing, your borrower will buy the property into one of our land trusts where our company is the trustee. And inside that land trust, you as the lender are the primary beneficiary and the borrower is the secondary beneficiary. So long as that borrower is paying the mortgage, whether it's interest-only payments or however your terms work, fixing up the property, paying the taxes, keeping it insured, and otherwise performing under your loan, the trustee will take direction of what to do from the borrower. Now, if it's something big, like the borrower comes with a permit application to demolish the house, the trustee is going to call you as the borrower, as the lender, as the primary beneficiary and say, hey, did you know the borrower is planning to tear the house down and destroy it and then rebuild it? And that comes in handy because we've actually had it where it was held inside of an LLC of the borrowers. The borrower destroyed the house and then ran out of money, and the lender was left with a vacant piece of land. So that's sort of your belt holding your pants up, is the land trust first. And it owns the property. All permit applications, notices of commencement, notices to owner, lien notices, tax notices, code enforcement notices, all will come to the trustee during the loan life, and the trustee will forward that both to the primary beneficiary, the lender, and the secondary beneficiary, the borrower. Now, you're also going to have a note and a mortgage that's going to get recorded, and the note is going to be signed by the trustee, the mortgage is going to be signed by the trustee on the property. And that's going to be recorded as a lien on the property, so you are also protected in that way. That's the suspenders. So you got the belt of the trust, the suspenders of the actual typical traditional loan documents that you're used to seeing. And then, of course, your borrower, the secondary beneficiary, is also going to personally guarantee it, and you're going to get personal guarantees from just about anyone else you want. Then we also have an escrow agreement where this house is being purchased for only $30,000. You're lending $150,000. $120,000 would go into an escrow account with us and be held. And then as work is done, the borrower, the investor, provides you pictures. You may have an inspector go in, make sure the work's being done properly. You tell us as escrow agent, as trustee, release the money, and we release the money as time goes on. So you're not giving $150,000 to this borrower up front for a $30,000 house, hoping that they use your money in that property and not somewhere else. So that's our belt and suspenders approach. But the beauty of it is, if there is a default inside the trust, if there's a default, primary beneficiary, lender gives the borrower, secondary beneficiary notice of the default, gives them 10 days to clear it up, pay the note, fix up the house, whatever they're supposed to be doing. If they don't do it, primary beneficiary notifies the trustee that the secondary beneficiary is defaulted. Primary beneficiary then takes over and gives direction to the trustee. And one of the directions they can give is, hey, give me a deed in lieu of foreclosure right now. And we'll give the deed in lieu of foreclosure to the lender, and they've repossessed the house immediately. If the borrower does fight for some reason, or if other liens have hit, you still have your mortgage out there, foreclose the mortgage, guess what? you're foreclosing a trust that you control, and you can tell the trustee, hey, sign this consent to the foreclosure. Trustee consents to the foreclosure, and the foreclosure happens usually in 60 days tops, 90 days at most, as opposed to years where you're having to foreclose directly your borrower. So that's our belt and suspenders approach to private lending.